Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm your host, Lance Pederson. This is the Real Estate Risk Report. So today, coming to us from Scottsdale, Arizona, a nice, calm 65-degree Scottsdale, Arizona, I've got Mike Stohler with the Gateway Private Equity Group. How you doing today, Mike?
Doing fantastic. How are you?
Doing wonderful. We actually got some blue skies here today. It's not quite 65, of course, but it's better than gray, gloomy downpour rain is what we usually get up here in Portland, Oregon this time of year. So yeah, thanks for joining us. So why don't you just give us a little bit of background into, kind of how you got into real estate, the types of investments you've been making. I know that you've, been an active kind of hotel investor and those sorts of things. Maybe just sort of give us a bit of background into how you got into this and that we'll start there.
Sure. I started investing in real estate. I don't know if there's an acronym for before internet or, before websites, before the help. So I did what a lot of people did. I read Kiyosaki's book and I liked it and, went to a seminar and knew that just like, probably most of your listeners, this is what I want to do. Well, I ended up buying some, I think 8 different properties. I went full in, and this is small town Indiana. Mm-hmm. And here's the thing is back then in seminar land, there was no internet, there's no help, there's no mentors. I bought them. And then it's like, okay, now what? Mm-hmm. How do you do a landlord? There's forms I have to fill out. What's these applications and all these addendums. And so it was an utter failure. And ended up giving all those homes back. But I knew that was the thing to do. So I actually went to work at one of the top real estate property management groups in the nation. And I learned how to become, I was all of a sudden managing 500 unit apartment complexes, 600 unit I learned how the people that did it, how to do it properly. But it scared us so much that, we took some time off. It's like, we don't make a lot of money. We don't make any money. Now we're in debt. Yeah. How do you do it? Fast forward to like 2011 and the, everything hit in 2007, 2008. And I was like, in the back of my head, I was like, now's the time to buy. We got to get back into it. I was, actually an airline pilot at the time. So I used all of my money and we started off with a fourplex in 2012. And I took that experience and I took all the lessons learned and did it the correct way. And from 2012, I went from the fourplex to now in, 2019 when I bought my last hotel. I've gone from that little fourplex to 2 hotels and a dozen single family homes in basically 7 years. Learning all the lessons, getting mentors, doing it the proper way, learning from all the mistakes that I've been making. Yeah. And, now we're syndicating and having funds and we're having a blast.
Yeah, that's great. So when did you stop being a pilot? Are you still a pilot or what's the?
I am not. That's another story. I was flying into Houston on an airliner during a lot of wind shear, level 4 type of winds, and the airplane jacked so hard that I actually tore some muscles in my forearm. Wow. And that was my last flight. And, and what I did, everything is a blessing in disguise. Whenever hardships come, it's okay. Do I wallow in pity or do I say, yep, that was a mistake. Don't ever do it again. Slap yourself upside the head. But also everything is a blessing in disguise. It just depends on, my dream job was to always be an airline pilot. Well, I could wallow and say, well, I'm no longer an airline pilot. Boo-hoo. But the blessing was because I was on disability, I looked at how the property management group was running our apartment complexes. And I realized, because of my past experience, that they're nickel and diming us to death.
Yeah.
So I fired them, did it myself, and the rest is history. So it was a blessing that I was no longer a pilot.
Yeah, because like I said, I mean, you're busy. I mean, being a pilot, full-time gig, not paying that close attention. I think a lot of it in this business, right, is that it just comes down to, I mean, discipline is huge. The best investors are those who are disciplined. Mm-hmm. Like anything. I mean, it's just any investing in general. I mean, the good ones are disciplined. They're not speculators. They're patient and analytical. And
yep.
But that is sometimes the hard thing, is that there's a lot of details. There's lots of stuff going on, and you're busy and you're not paying attention to things like that. And that is sort of a knock on, much of the property management industry, especially the third party managers. It's just, they're finding other ways to sort of, like you said, nickel and dime, or sort of scrape fees and those sorts of things. And, and you kind of lose sight of it if you're not paying attention. So for you then, so you started managing your own properties. What sort of led to, I mean, at this point, when did you sort of get into the hospitality side of things, or what kind of led to, to that particular property type?
Yeah, that was a great question. I had owned fairly large apartment complexes, multifamily, 4, 5, 6 years ago. And everyone was getting, here we go. I was starting to see the 2005, 2006, everything was starting to raise up. The cap rates were starting to go down. And I was starting to get offers on my apartment complexes sight unseen. And I'm thinking, okay, bells are ringing. This is something that went around. It was going on around 2005 or so. And so I was like, why not? These guys are giving me stupid money. So I started selling off the multifamily, and it came down to this one apartment complex that was fairly large. I had it 10 months, and I'd sold them like all in kind of a quick time period. And the last one that we had, and I was going to make right at a 6-figure profit in the 10 months that I owned it. And I was like, okay, I can't take the hit. I have to 1031 exchange this thing with all the funds, but I don't want to be someone else's fool.
Exactly.
My way to put it is, because now we're talking at that time, 5.5 cap rates. And I just wasn't going to do it. I usually do a longer term hold, and I was just not going to do it. So I didn't know what to put it into. So I started, one thing that everyone will start to learn is that you have this network, and no matter, you do hotels. Well, I don't do them. Then don't just never talk to them again. Always taking people out for lunch and diversify. And even if you're not into it now. So I actually called this guy back up and said, hey, and I'm a creative guy, I said, if I bring you in as a partner on this one hotel, matter of fact, you have to find me a hotel because I don't know anything about them. You teach me. I'm not going to pay you, but I'll give you a cut of the profits.
Mm-hmm. And
there we go. Now I got into the hospitality industry at that was the 9.5 cap. And it's gangbusters, and now we're off and running with syndications and funds and doing all sorts of things. So that's how it kind of started. I did not want to get into it. And now the, hospitality or the multifamily's down in 4.5 cap. And we're looking at hotels that are still in the 9 caps.
Yeah. Yeah, because it was overheated. So translation, you sort of like, okay, let's get out at the top here. Mm-hmm. And then was that deal that you did, the hotel deal, did you 1031 exchange into that deal then?
Mm-hmm.
Yeah,
I did.
Yeah. So it's just so basically you didn't want to pay Uncle Sam. Those were short-term. Those would have been short-term capital gains. Sounds like, because it was under the holding period was too short.
Yep.
So you were going to take a hit. You wanted to get out just for those to translate, right? And then you've got the time pressure of you've got a window of time to do the exchange to defer the taxes.
Correct. And if I bought another multifamily, everyone all of a sudden was selling at top dollar.
Yeah.
And I was even looking at some multifamilies that I had even owned prior. And I'm like, I know that's not worth it. That's stupid. I'm not paying this. Yeah. So that's, and some others, because I've been in the industry for so long. But so, got into hospitality.
So in terms of so let's kind of dig into hospitality. Obviously, much of that sector has been sort of ravaged by the pandemic. Now, not all hospitality is equal. So maybe share with us, what markets are you invested in? What type of, assets have you looked at or invested in? And, and I know that, you're down in Arizona, so lots of things, I've got some friends down in Arizona doing short-term rentals, and a lot of stuff is just really, in fact, it's better this year than it was the year before, but maybe give us a little insight into, what type of stuff you guys were looking at, or your thought process when selecting the first asset and the markets and those things.
Yeah. And it's a great question, because my mindset prior to COVID, I've switched 180 degrees. So when you're analytical, the good thing about me, and my investors would say about me, is because I'm probably an airline pilot. I'm very checklist, very analytical.
Yeah. I
never buy because of it looks pretty.
Yeah. Right.
Well, but prior, it's like everyone's goal is like, hey, when are you going to, I want these big, these resorts and the Marriotts and these destinations, so we can go, just these pretty nice big conference rooms, type of hotels. Those are the first ones to go during COVID.
Yeah. And
if for those of your listeners that are into the multifamily, which ones are the ones that are probably making the most money? It's the C-class types of multifamily, or the blue collar type of single family homes.
Yeah.
It's the same thing with hotels now. And I've completely changed. I no longer want that big conference room, 4 pools, Marriott or Hyatt, Hilton thing. What I found out is limited service hotels. Those are the ones like Quality Inns, Comfort Inns, Country Inn and Suites. They're the ones that you get the free breakfast, the free Wi-Fi, and you're gone the next day. You usually stay maybe one or two nights. There's no restaurants.
Yeah.
They do have maybe a fitness center and a small swimming pool. Those are the bread and butter and of the hotels. And what we've figured out is also one of our hotels, it's in a small town, very small town outside of any major city in Arizona, but it's right along the highway, and it has truck driver parking.
Mm-hmm.
That hotel has been 60 to 85% occupied the entire time. So you do this thinking of what type of hotel and where. People did not want to stay inside of Phoenix or Tucson during the pandemic, so they stayed in these smaller towns along the highways, but they didn't want all the people. They didn't want the urban. They wanted to be outside. So our hotel was just extremely busy. The other side of it, a hotel that we bought, a Radisson, I thought, man, this is going to go gangbusters. It was in a business park, right outside of a tech area, and it was brand new. We just converted it to a Radisson, just did all these upgrades, and we were ready. COVID hit, no business travel, and even though that hotel's never closed, it's not doing. We had to completely shift its function. So you have to dive into those analytics and find out. It's like, okay, you know what, that Motel 6, no one wants to go there, but everyone wants to own it right now.
Yeah, that's interesting. Yeah, and like you said, it's just that the whole pandemic thing of just not necessarily part of the underwriting checklist. Oh wait, a
Mhm.
pandemic. How will this thing stand up in the pandemic? And like you said, the business travel has been the thing; it gets crushed. So I mean,
Mhm.
before I said, I think any of us, it's easy in hindsight. It's always 2020,
Yeah.
but I think most of us would have. It's the same thing. It's like, man, all these hotels were up in here in Portland, right? You got Intel and stuff like
Mhm.
all these hotels around Intel and people are flying in and whatever. I mean, that should always be busy, right? Like that's that, but yeah, but that not in the pandemic, right? So and then
Right.
to like what you're saying is that the other I think that's just it, is that the truck drivers and those sorts of things,
They don't stop.
they don't stop. It's just it keeps going and people need to, they need a place to stay. And
Mhm.
um so with that, I mean, has there been it seems that at that band of the market in hospitality, is there sort of what are the other sort of moving parts? Like it seems like I've heard over the years that some of these guys buy assets like that, and then they basically just like wring everything out of them to the point of like obsolescence, where so like not much capex. Or so like who are you up against? Like who else is in that market competing to buy stuff, or is there not much depth to the buy to that side of it?
Yeah, it's when you buy franchised hotels, you can't wring it dry. I mean, you just can't. They're a Radisson or a Marriott's not going to let you. You have to keep up a certain persona in order for you to have that name. If you do an independent, you can probably get by with something like that. But uh, if you and I travel to a country inn and suites or a comfort inn, you want it to look, no matter where you're at in the United States, it kind of looks the same. You know that I'm going to stay at a comfort inn or a quality inn, and there's a certain level of expectation that you're going to see as far as cleanliness and how well it's presented. Um, so we don't do that, and I'm not going to wring it out for our investors. I'm just not going to do it.
Yeah.
The people that buy into hotels, you have, as far as like me with the private equity group, I mean, my God, you have the Blackstones and things like that. And,
Sure.
they're pumping billions of dollars and they just bought, but, they're buying the 600 million, $500 million resorts
Yeah. Different
and
ballgame.
it's a different ball game. But a lot of it is you have private equity groups that know hospitality, ones like myself, that we just grab investors and we do either funds, and then we turn the funds into syndications, or we do with family offices, different type of JV agreement. But it's usually general partner, limited partner type of syndication. And, then you get some people like myself that are just individual buyers, that just mom and pop hotels.
Yeah. And it seems like from what I've understood is that sort of dominates a lot of that landscape. Is there's just sort of, there's these one-off investors who, who sort of control those, which,
a lot of like people from India, are extremely, extremely involved in the hotel industry, hospitality industry. They really know what they do. It's multi-generational ownership. And what's great is if you're a mom and pop, you buy a Hilton or you buy a Radisson, and then your children get involved in it, and then the children end up buying a hotel, and then now you kind of build your generational wealth that way.
and do you see then, is there, when it comes to being kind of a hotel operator in this line, then is there something to the operational efficiencies of having numerous assets? I mean, does that, I mean, in this case, I mean, because when you think about it, so we look back at the capital structure. So how I interpret what you're saying is that, okay, there's people that buy them and hold them on their own, whatever, right? In this case, you're syndicating the equity required on an asset by asset basis. And you as the operator are charging. So the real estate is held by an entity that you syndicated the equity to acquire it. And then you're charging what amounts to a property management fee to manage it on behalf of that. So any operational efficiencies you can create by owning multiple properties would be accretive to you, right, as the operator, because your ability to generate for that property management revenue stream to be a profitable one is easier when it's like the guy from Subway, right? They opened 2 of them or whatever, and they're losing their shorts, and he's like, what we really need to do is we need to open 8 more. Which of course is a bit counterintuitive to most, but that makes sense. So with that said, for you guys, as you're executing that particular strategy, does that then are you looking more geographic, like, hey, we want to own as many as we can that are close, or does it not really? Is that really?
Yeah, that doesn't matter. It's vendors are vendors, and where you save money is number one. You're known within a certain brand. And then when you go to, let's say, the Marriott's or the Radisson or Choice Hotels, there's probably 30 or 40 vendors, so people that are trying to get in hotels, don't do it alone. It's a business.
Yeah, that's right.
Okay. It's not just real estate. It's a business. We have a lot of employees. We have contracts with the vendors, and that's where the relationship part really helps you, is in the relationship with the vendors. And then I say, it's all right. It doesn't matter where they are in the nation, because, Cisco Foods is Cisco Foods and they're national, right?
Yeah.
Or some other type of vendor, US Foods. So it's the fact that I just have 4 or 5 hotels, and I can use that to buy in multiples, but then ship them out other different places. But it also helps when you have like Radisson or Marriott or Hilton or Choice, their type of buying power also, and the different discounts. But the biggest difference is when you go to with hotels, it's very hard, unless you do a CMBS loan. It's very hard to get a loan that you don't have to personally guarantee. And so now it's like, okay, well, I've got 4 of these. I have experience, and that's really where it comes in, where I'm able to get the lower rates for the capital that we're getting. Yeah, and you get to know the different capital people. You get to know the SBA guys, and that's another big thing about hotels and how we have survived is because we're a small business. All the different CARES Acts, we are able to get the PPP loans. We are able to get the economic disaster loans. We're able to get all this help because we are actually a small business. Each hotel is its own small business because it's owned by a separate LLC, and its whole entity, a different SBA loan. So that's what's really helped us is that, and that's what a lot of people don't realize. They think they're just kind of jumping up in a different real estate asset class, and it's not. What you're doing is you're jumping from a real estate asset class to a business that happens to have real estate that sits on real estate.
Yep.
So it's a whole other, it's a double play. You have an appreciating asset, which is the real estate and the land, but you're running a business.
Yeah. And then for most, then when they get into like, a syndicated, hotel, like we're talking about, is it, really when you're positioning it, or the problem it solves in the investor's portfolio, obviously you mentioned the fact that, it's real estate, there's going to be some amount of appreciation over time. But really, is it sort of more of it does have a little bit, the cash flow is a little more, like you said, 8-9 cap. So obviously it's going to depend. It could be seasonal depending upon where it's located and those sorts of things. But it ends up being, kind of a cash flow play you put money into. And is that how you kind of position it?
Yeah, it's both. Hotels are a longer term hold. Okay. You can't just go in like a multi-family, put lipstick on it and flip it. It's especially when you're dealing with franchises. You have to go in, stabilize it. You have to show the numbers, and then within 3 to 5 or even 10 years, then sell it as it appreciates. But what we tell the syndicators is there's a double play. We do something, and maybe someone with a larger multifamily does the same thing, but it's also a very big tax play. So if you have accredited investors, their K1s are going to show all the different types of losses. We get to depreciate a lot more than like multifamilies.
Yeah,
we do what's
property accelerated appreciation.
All that, the cost segregation. And I've had a lot of investors that were multifamily people. They join on one hotel. It's like, okay, we just want to see what it's like. They get their K1 at the end of the year, and all of a sudden I get this really nice bottle of wine in the mail, because they had no clue what type of, even though you make money, what kind of losses that you show on paper. By owning this type of a business, and it's just amazing. So where hotels make their money is towards the end. It's at the sale. It's just the appreciation of the asset, and it's going through the next generational, like with Radisson or Marriott. You do the upgrades, to the next gen of what they want the hotel to look like.
Mm-hmm.
And you show the performance, and you just do all the different little things. You get the corporate bookings, you get all the different contracts, you get the federal contracts, you do all these different things. But that takes years. I mean, it just takes a long time for people to all of a sudden say, oh, you know what? I want to go to this hotel instead of this one.
Yeah.
None of that stuff. But there is, during non-COVID, there are returns, and so you do get, and with the syndications, you get preferred equity, you get preferred returns, right? And then the different waterfalls. So it becomes as complicated or as easy as you want it to be within the syndication.
Sure. Yeah, exactly how you structure it. But I mean, in terms of like you acquire an asset, and I think you're alluding to some of this stuff, but sort of you bought it from someone who did whatever they maybe it was 7 years ago or 8 years ago, where they did the next gen upgrade, and then they've sort of, they've went down. But like for you guys, when you're assessing opportunities, what is it that you're looking for? I mean, I'm assuming it's some sort of mismanagement, right? There's just some sort of untapped opportunity. Maybe give us, kind of the top 3 or 4 things that you guys are doing when you get a hold of these assets to sort of begin that process, that value add sort of process.
Yeah, what we do is number one, we try to, just like with multifamily, we try to get off market. But if it is on market, we look at the mom and pop operators that got in over their head. They went from one hotel, maybe a very small extended stay, to this, and then it gets up, and they were able to buy it, but then now they have to put in $600,000 or $800,000 in what we call the PIP, which is the improvement, and in order to stay a Marriott, and they don't have that kind of funding. They just don't have that kind of money. So they just say, well, we're not going to do it. And then they start kind of squeezing it.
Okay.
And it becomes mismanaged. And then we go in and say, okay, look, we're going to have to put hundreds and hundreds of $1,000s into this thing. So then we force them, we get it, the better rates of the, just like any type of negotiations. But we look at that, and then we look at what vendors are they using, and just like you would in multifamily, where can I save some money and put in our management, put in our vendors, our friends, that do things, and where can we save money? Another one, he had just converted the hotel to another one, didn't realize what he was getting into, because during the conversion, he lost 10 months of revenue. He went from a Marriott to a Radisson, and during that 10-month conversion period, he basically lost everything and then couldn't recoup.
Yeah.
and it was a great location. We just, in that type of situation, you need to come in, and when you do syndications, you need to pad the, you need the cash in order to work it.
Work your business model.
Work the business model, and
your reserves. You need to have appropriate reserves.
Yeah.
Because so it seems like this is where the flags, the Radisson, the Marriott, it really does drive a lot of the activity, because some people can't keep up with the times. They do then become they're reluctant, forced sellers. They're in bad positions, or they attempt to move from one flag to the next and get stuck because they don't have enough reserves.
Mm-hmm.
So in that regard, it sounds like on the acquisition side, it's a bit opportunistic, and it goes back to that discipline and patience we were talking about. Is just being aware who's out there, what the properties are, who's
Mm-hmm.
running them, where they're at, and sort of their life cycle, and then
Mm-hmm.
being opportunistic in the sense of, hey, these guys are kind of in a pinch, right? We can go in, solve the problem.
Mm-hmm.
And be better capitalized, and then obviously with some better management, operational efficiencies,
Mm-hmm.
those sorts of things.
Yeah, because they're getting ready to lose the flag. If they don't do this, all of a sudden they're nothing.
Yeah,
They're no longer a Marriott. They're no longer a Hyatt. They're nothing. They're all of a sudden they're independent, and that's when they lose all their computer systems. They lose everything, all the back end stuff, and so they basically have to sell, and then I'm happy to buy it.
Yeah. So I guess in the context of the COVID stuff, have you guys seen more opportunity of some that, obviously, aside from all the PPP and the things that have been put in place to try to help people, has it created more opportunity though? Because once again, if you don't have the appropriate capitalization, is it putting people in positions they wouldn't have been in otherwise, and sort of creating more forced sellers?
Yes. Yeah. We're starting to see it now. I'm getting ready to open up. I'm beginning stages opening up a fund in order for, to do that. What we're seeing is twofold. There's a security type of loan program. It's called CMBS. And it's basically security. It's not a bank loan. You're buying a loan through the market, basically. And those type of loans, they don't know how to grant deferments like regular banks.
That's right.
You're not allowed to have any type of a second attached. So the economic disaster loans that everyone got, they're not allowed to have them.
Yeah.
The PPP loans to help keep all the employees, they're not allowed to have them. So they're stuck with no help. So those are the ones that are currently starting in default now, and they're starting to go to auction very soon. But the other ones, if you didn't buy it right, that's why I'm not going to buy a 4-cap multifamily.
Yeah, that's right.
Okay, it's speculation. You're speculating that the economy is going to continue, and that every 4 years we could do flip, because we have a presidential election. Something happens, and I just will not buy on speculation. I buy for the cash flow. I buy for the long-term hold. I don't want to get to the point where something happens that's bad. It's like, I don't care because I don't have to sell.
Yep.
So people that speculated and they bought an asset, a hotel asset that had a lot of business type of focus with, the different rooms, different conference areas, restaurants, spas.
Crushed.
They're crushed, because there's no additional type of revenue for them, and they may be in an urban setting where no one's traveling, no one wants to travel. So they're going to get hit really hard, and that's when you go in and guys like me, instead of putting the 20% down, it's like, what? I've learned from this. I'm not going to buy anything unless I know that I can get 30, 40, 50% down. It's so that we just even have more room to cushion.
Yeah. So translation, you're just saying that for you'd rather go in with a little less leverage, more equity. It just gives you because otherwise then you end up putting yourself in the same position that these other people are putting them in, where things that you had nothing to do with, market forces or whatnot, sort of then, put you in a position. I mean, that's just it. That's why leverage is always, it is a double-edged sword. I mean, it obviously is great at enhancing returns and, there's all sorts of good things about it, but it's just, and to your point about CMBS, I mean, there's no sole decision maker, right? Like they've literally split that thing up into triple A's, double A's, like it's crazy. And, and I get it. Like it makes sense why they do that. They're basically, unbundling it and creating different, risk profiles where you're at in the stack. And, like it's interesting financial engineering, but the problem with it is that there's no face to talk to and it's hard and fast. Whatever was laid down, it ends up potentially pushing you in positions where, you can wipe all that equity out, even though, not necessarily through any fault of your own, other than, getting that kind of financing or whatever. Yep. No, it makes a lot of sense. So so you guys are sort of preparing for the fact that, hey, you're going to see more of this as these things run out. A lot of people are going to be kind of forced in a position where you can pick it up at a good basis. Don't worry so much about levering the crap out of it. Just get a hold of these assets basically it's the clearance rack is sort of what your strategy is.
Yeah. And there's even opportunities that I'm starting to see where you can just take over the loan.
Yeah.
And
yeah, that's right. Yeah. Just assume the loan and you come in, you got a stronger balance sheet behind it. Then, that makes a lot of sense. Cool. So I guess, I always like to kind of end off with, what for you, maybe it's an investment you've made or, or something you've seen just from afar, but, kind of you got any juicy stories for like imploded deals, like deals that just completely went sideways, that, kind of the war stories, anything good in that realm or maybe just mistakes you see people making kind of in the hospitality industry or something, cautionary tale of, one
of the big cautionary tales, and thank God we didn't do it because my brain, everything was going, don't do it. Don't do it. Don't do it. You get into situations where if someone, and this is along all assets for everyone, no matter what asset class you're buying into, if someone's in a hurry it's kind of like the fast car, the used car salesperson. If they're like, okay, let's get this done. Why do we do it? And they won't allow you to kind of focus in and ask questions. Don't buy it because there's something that they're getting sneaky. They're trying to, and I had an opportunity to buy this hotel that was wonderful. And they had like this contract with the railroad. They had a contract with, it was a State Department. They had all these things. And I was like, okay, let's go in, let's buy it if the price is right. But then I was like, okay, I have some questions because there's some other hotels coming in. And then I had questions. Okay, can I see the contract with the railroads? And I want to be able to see how long it is. And they're like, well, I'll tell you what, I'll give you $200,000 less, and they just went over. And all of a sudden it's like, oh, wow, I can get this $200,000 less. Well, if I was new, maybe I'd forget that I had just asked some questions.
Right.
That really had, but then focus on, oh, wow, I can get this for a cheaper price. So, and some of the people that I teach on the hospitality and things like that, it's these questions that I have. If you make sure that every single one of these are checked off.
Yeah. And
that would have been a horror story because they were losing all of these contracts. They were losing. I found out that it was it's not all roses.
Yep.
In some of these asset classes.
Yeah. No, I mean, it's true. It goes back to the discipline thing again. It's just, there's all these things that you need to look at and due diligence and it is hard, right? Because as syndicating deals is that, you find an asset you like, you tie it up, right? You got an earnest money that's going hard. You've got a due diligence period, and it is. I mean, it inherently has this sort of like, hurry up, let's get this thing done, and there's all these, there's these deadlines that just exist. Like, and you've got arranged financing and all these things, and it's easy to overlook and sort of gloss over stuff like that are absolute deal killers, like contracts or some environmental type issues or some sewer or some municipality type things that, it's just, that's the kind of stuff that, if you're just too, overly eager and not willing to just walk away from any deal, they can bite you. And it's just like you said, it's like, first things first, like never overpay for anything. But second thing is like, just make damn sure you know what you're getting.
And make sure the drivers are there. Something else I learned real quick is, before it's like, okay, I had Radisson wanted me to build a hotel in a ski resort, and it's this brand new development, and it's going to be beautiful, fantastic. And I was like, oh, wow, man, I am okay. Here we go. I'm big time now. And then all of a sudden I was like, but wait a minute. Okay. Back to your guns. That's only one driver that's going to bring not 3 or 4. If there's no ski resort, it doesn't snow. Yeah. You're not getting people. If another pandemic hits and they're not allowing people to ski, there's no hotel, there's no guests. So I've switched it. It can't be, well, this is perfect for spring training. Everyone's going to you'll make your entire year's profits on spring training. Well, guess what happened last year in Arizona? Canceled. So if you get into hospitality, 2, 3, 4 different drivers, what are 4 different reasons that people will come to your hotel?
Yeah, exactly.
If there's 2, it's not good enough.
Yep. Yeah. And that's just it. It's the nuance of all this stuff, right? It's just and it gets boring. I mean, it's boring, right? It's boring in that regard, but it just can't be understated is that investing in anything requires ton of discipline. People who, like you said, if they start acting like used car salesmen, probably a good indicator that, you should, back away and kind of reassess, because it just, if that's how they're wired, then that's how they make decisions. And it's subtle, but yeah, it is the whole, if they operate if all the airline pilots, to your point, operated where they're just willing to skip step 7, step 12 or whatever, many of us would have perished in some fiery plane crash.
That's right.
It's just, you can't skip steps. You got to be disciplined. You got to be willing to walk away. And that goes for, and this is what I mean. Think this is how active investors are processing. This is how they look at things. They're patient. They're not going to be, they're not going to get overly excited by things, or, it's not going to let that emotion sort of get caught up in it.
Yep.
And it's the same thing that passive investors need to do. Right. And I know that it's hard for many syndicators, whatever, because they're the guys who need to somehow raise $1 million, 2, 3, 4, 5, 10 in 45 days. But it's like, if you didn't start building a relationship with that investor 6, 9, 12, 15 months ago, right? I mean, they're not going to, if they're any good, they're not going to be moving any faster than they need to either, right? Like there's only downside risk in moving faster. And so everyone needs to appreciate that. And that's just how it goes. So there is no rush, and it takes time, and it's all the long game. No matter what you're doing, if you get into this business, you just got to be willing to be doing it for 30 years, like 30, 40 years. It's just not the notion that it's sort of this get rich quick, or if anyone thinks that, it's just, you're out of your mind. It's get rich really, really freaking slow.
Quit watching HGTV.
Yeah. It's just,
it's just, things don't happen in an hour episode.
Yeah, they don't. And to the degree that it may or could or whatever, it's just, it's the amount of risk that one's taking on is just all out of proportion for more than likely whatever the return might be. Yeah. So good stuff. So where can people find you, Mike?
Yeah. LinkedIn, look me up, Mike Stohler. And we're at www.gatewaype, as in privateequity.com. And if you are interested in podcasts, we have our own podcast. It's therichergeek.com.
TheRicherGeek.com. Very good. And Mike is also a fellow golfer like myself. So, I might need to find my way down to Scottsdale to chase a little white ball around the course with Mike. But of course, in our own separate carts, make sure to make
That's right.
So cool, Mike. Well, thanks so much for joining us today. I really appreciate the time. Good conversation. Take care.
Take care.